He lost everything. How did this happen? Roughly $7 billion of internal value evaporated after a risky decision that turned the company's own capital into an auction. The consequence was simple. The company vanished. Sears began as an American retail giant with decades of scale, real estate, and brand recognition. After the Kmart merger and Eddie Lampert's rise, control centralized under management tied to his hedge fund. That governance shift changed a history of pooled budgets and operating priorities into something else. The decision was explicit. Management converted Sears's capital allocation process into an internal capital market. Divisions, stores, and business units no longer received planned budgets. They had to earn funding by bidding for it. Winning was not based on long-term network health. It was based on projects and cash flows that pleased the owner and the balance sheet that sat across from him. At first, the numbers told a flattering story. Cash inflows increased. The corporate balance sheet showed liquidity workarounds. Executives and some investors praised the financial engineering. Store managers who won funding felt vindicated. Workers breathed easier when a store cleared a round of investment. That early momentum masked how incentives had already changed. Warning signs emerged quickly. Stores that lost capital contests showed deferred maintenance. Aisles thinned. Inventory fell. Restocking slowed. Vendors complained. Internal audits flagged chronic underinvestment in locations that repeatedly failed to win bids. Market share began to leak away as customers encountered empty shelves and inconsistent service. Pressure rose in stages. At first, individual stores withheld from capital contests recorded modest sales declines and shrinking margins. Then repeated withholding forced suppliers to tighten terms and reduce shipments. Shortages became visible on the floor. As more locations deteriorated, foot traffic dropped and revenues slid across regions. Credit ratings fell. Access to external financing tightened. Liquidity stress became a dominant concern. The pattern escalated rapidly. Liquidity pressure forced aggressive asset sales and concessions. Each forced sale accelerated store closures and reduced the company's ability to support remaining operations. What started as an internal repricing of projects turned into a cascade of operational failure. The turning point arrived when creditors, suppliers, and employees saw the arithmetic behind the early wins. The short-term financial gains were covering long-term rot. Layoffs multiplied. Local communities watched longtime anchors shudder. Veterans who had spent decades at the company sat in empty stores and watched decades of work unravel. For many, the realization was brutal. The system had been hollowed out from the inside. The structural model collapsed. The company filed for bankruptcy. Thousands of stores closed. Brand equity eroded. Roughly $7 billion of internal value, the cumulative worth embedded in stores, inventories, operations, and regional networks, evaporated. What remained was a corporate shell and a trail of sold or repurposed property. Behind that collapse, the financial story continued. A decade-long shift of real estate and other assets flowed into a private real estate trust tied to interests associated with the company's controlling management. The retail collapse served as cover for that movement. Stores shut, leases were renegotiated, property titles changed hands, and ownership of key parcels exited the operating company into separate vehicles. Investors and related parties captured recoveries on assets. Employees, suppliers, and communities absorbed the losses. The institutional fallout was comprehensive. Creditors and bondholders recovered parts of book value through sales and restructurings. Suppliers wrote off receivables. Pensioners and workers faced reduced benefits and lost jobs. Towns lost economic anchors. The industry watched a dominant chain shrink into a memory, and its real estate reoriented toward investors rather than store operations. Forensic economics reads this as a case study in governance choices. The internal capital market was not neutral. It changed incentives. It rewarded extraction and short-term cash at the expense of network health. Capital that could have supported restocking, repairs, and long-term merchandising instead prioritized projects that produced favorable accounting or fed separate asset vehicles. There were prior warnings embedded in the choices. The Kmart merger and the concentration of control under management tied to the hedge fund set the conditions for converting operating decisions into financial contests. Internal audits and vendor flags documented the decay. The repeated pattern of withholding, tightening supply, and forced sales predicted the outcome long before bankruptcy was filed. Stay with this story. The human costs are stark. Former employees navigated sudden unemployment. Communities lost local tax base and foot traffic. Suppliers who had extended credit based on decades-long relations found themselves unpaid or forced into tighter terms. Small businesses near shuttered stores declined as customer flows vanished. The company's veterans watched a once dominant empire dissolve. The long-term industry lesson is clear. When governance structures permit or encourage the use of a company's operational assets to feed separate investment vehicles, the visible financial gains can mask irreversible operational loss. The accounting gains and asset recoveries for investors do not erase the real economic damage to workers, suppliers, and communities. The final lesson is blunt and hard-earned. Weaponized internal capital markets destroy operational capacity. Extraction looks like efficiency at first. Over time, it becomes collapse. Learn the warning signs.